Hello everyone, welcome back to our channel. Today, we're diving into a topic we all love, high returns. Ever wondered how to find those legendary Tenbagger stocks in the market? You know, the kind of stocks that could double your account value overnight. Well, that's exactly what we're discussing today. When it comes to finding these gems, we can't ignore two investing legends, Peter Lynch and Warren Buffett. These two are like the Sherlocks of stocks, always spotting those hidden gems and quietly raking in profits. Back when Peter Lynch managed the Fidelity Magellan Fund, he practically created a legend with his returns. When he took over, the fund's assets were only $18 million, but by the time he retired, it had grown to an astonishing $14 billion, with an average annual return of 29.2%. What does that mean? If you had invested $1,000 when Lynch took over, by the time he retired, your $1,000 would have become $28,000. Pretty thrilling, right? But don't rush just yet. Today, we're going to follow Lynch's lead and learn how he found those Tenbagger stocks. To make this easier to understand, we'll also look at one of his classic investments, Dunkin' Donuts, and break down how he made big bucks by investing in a donut shop. Want to know more? Hit that like button, subscribe, and let's dive into the secrets of the stock market together.
You look for companies that have something unique. Like an example would be Toys R Us when I first found that. You know, they only had 7 or 8 stores. You said to yourself, this concept could have 200 or 300 stores.
Now, by nature, some of those companies might be very boring.
Well, yeah, that's terrific. That's great. Companies that are boring are wonderful for me. I've done well with companies like Dunkin' Donuts. Well, companies like that, they're very easy to understand. No one's going to invent a better donut somewhere at MIT. You don't have to worry about Korean imports.
How do you analyze a Dunkin' Donuts company?
Well, there's a company that upgraded their stores. It spent a lot of time on the quality of their product. They really spent a lot of time to have a china cup. Their cup was worth over $1 instead of just having a piece of paper or a plastic cup. They said, we want to deliver something very good to the consumer. They really worked on the quality of their coffee. You know, every 15 minutes they'd throw it away, and they'd cook it within 3 degrees of the right temperature. They really cared about all that.
Did you find that in an annual report?
No, you had to go visit them and talk to them. But you could find it out. You'd say, this is something that really makes sense. And the nice thing about it is, if somebody comes up with a good donut system, and they really have a great concept, it's in the state of Washington, it's not going to affect Dunkin' Donuts if they're located in Virginia, if they're located in Massachusetts.
Now, how did you stumble on legs?
This is a product my wife said worked very good. And at that point in time, I did a little bit of research, and I found out the average woman goes to the supermarket about twice a week. And all the hosiery being sold in supermarkets was just junk. So here was a company that made a good product, put it into the supermarkets, put it into the drugstores, made it readily available. It was an incredible success. It was the most successful product of the 1970s after Pampers. But Pampers was part of a very big company called Procter & Gamble. This is part of a relatively small company called Hanes. So the stock was a huge success. It was eventually bought out by Consolidated Foods, a company who's now called Sara Lee. If it wasn't bought out, I think it would have been a 100-bagger instead of just a 10-bagger. It was a big success.
At what point do you decide in a company to cut your losses?
It's only if the company's doing poorly. If you bought a company because you thought this new product was going to work, or the aluminum industry was turning around and you know something about the aluminum industry, if all of a sudden the product isn't working or the industry's getting worse, if you're wrong in the fundamentals, then you sell. If the company's doing fine and the stock goes down, that's a great opportunity.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny, in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10-baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. You say, still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because the earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you could lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Does your own confidence ever get shaken?
Every day I think the market's going to go up. You know? I keep calling a lot.
So you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to.
All right, after hearing Peter Lynch's insights, doesn't it feel like finding a 10-bagger isn't just a distant dream anymore? In fact, Lynch's investing approach boils down to 5 standards. Keep these in mind and see if the stocks you're eyeing might just have that multi-bagger potential. First of all, uniqueness. As Warren Buffett describes, a company needs a moat or something unique about its product or service. Think of Apple, relies on its unique brand positioning and product design. It has attracted a legion of loyal fans. It's now a giant that sells whatever it puts out. The next criteria is understandability. You should know what you're buying and understand the company's business model and future. Lynch's famous phrase, know what you own, perfectly captures this idea. Don't just follow trends blindly. Third, market attention. Look for those hidden gems that the market hasn't caught on to yet, not the hyped-up stocks everyone's talking about. If a stock's already hyped to the moon, beware of the freefall that might follow. Fourth, growth potential. Choose small companies with massive growth potential. Giants like Apple or Amazon are already huge, so getting another 10x return might require something like humans colonizing Mars. Final point, don't sell too early. Lynch nailed it with, don't cut the flowers and water the weeds. If you're confident in a stock, hold on to it. Don't let minor fluctuations shake you. Peter Lynch's investment in Dunkin' Donuts is a great example of these 5 principles in action. Dunkin' Donuts was just a simple coffee and donut company, but it had a unique business model focusing on delivering high-quality products and great customer experience. Also, Lynch had a deep understanding of Dunkin' Donuts' business model. At the time, Dunkin' Donuts wasn't attracting much market attention, and its stock price was relatively low. But Lynch saw its massive market potential and recognized its value, held on to its stock for the long term, and ultimately reaped substantial rewards. So do you feel like finding a 10-bagger is within reach? Investing doesn't have to be as complicated as it seems. With the right methods, you could be the next stock market star. If you found today's content helpful, don't forget to like, subscribe, and hit the notification bell. See you next time, and happy investing.